Welcome back, everyone, to the Mortgage Heroes Weekly Podcast. I'm Andy.
And I'm Brian.
And I'm Will.
So today, guys, we have a couple of really good topics to talk about. And then one I'm really a little bit confused by, but let's go from the top to the bottom. We got mortgage rates fall to levels not seen since September.
Yeah.
FHFA conforming loan limits increased to $766,550 in 2024. Pending home sales dropped to record low, even worse than during the financial crisis. Womp womp. And home prices will fall in 2024 from Morgan Stanley. We're going to argue about that one because I'm not so sure. So let's go to the first article, guys. First article up today is mortgage rates fall to levels not seen since September. Thank God. What a great way to come into the end of the year, start December with mortgage rates falling even further after consecutive weeks of falling in November.
Wow.
Keep it coming. Keep it coming.
Yeah.
You know, all I can say is like you make it seem, Andy, like it was so long ago when we saw these rates. It was just like... Yeah,
well,
you know.
But what happened in between September and December? We had October where it was just
boy.
we started
boy.
rubbing elbows with 8%, and everyone was like, I don't like this. Don't touch me.
It was crazy. That's the time where, you know, I used that example where I had a client with a $740,000 purchase on a townhome here in San Diego, which is pretty nuts, right? With HOA and everything, his payment was like almost $6,700. Why? Because, and this is VA, no money down. Obviously, that's why it's high, but they had excellent credit scores, etc. 7.5%. And when you have to close escrow so early, you got to lock that thing in and you got to go. Otherwise, you know, you roll the dice and hoping that the rates don't go to the 8s.
Roll, right?
And it's been very refreshing the last couple of weeks being able to get that downward pressure of the rates. And going into 2024, I believe this is a great window to start getting, you know, your finances in line, start, you know, checking the water, see how it is going into 2024 for everybody that's looking to buy in the spring. You want to start the process, you know, 3 months beforehand to really get an idea of what you can expect, because once rates continue to drop, just believe me, you're not going to be the only one rushing to join them.
Oh no,
it's not. It's already the case right now.
Nope.
You're not the only one looking for to buy a house or refinance, even if the rate is what it is today. What was interesting to me about this article is that, you know, it's citing that the 10-year Treasury, which we talk about here a lot on the show, there's a relationship and a correlation between the fixed mortgage rates on the 30-year fixed and the 10-year Treasury yield. So the 10-year Treasury yield dropped to below 4.3% for the first time since September. Now, again, they are not necessarily inextricably linked, but they do run the same course oftentimes. And I think, obviously, as a result of that, you're going to start seeing that, you know, mortgage rates are going to stay around here for a little while, maybe to close out December, because it is just the way that the market is trending towards that. And we have more to talk about that later when it comes to asset managers saying that mortgage-backed securities might be a safe play in the new year too.
Whoa.
Ho, ho, ho. But one thing I wanted to say for those that don't know at home, the 10-year Treasury works kind of like a sneak peek into where you think rates are going to be. So for those at home, if you want to know if rates are going to be up or down, just check the 10-year Treasury, and if it's on the way up, you can expect rates to follow that trend, and if it's on the way down, same thing. So that's one of the tools that you can utilize to know if rates are up or down, or, you know, the direction they'll be heading.
Wow. Is that still working?
Yeah.
Well, for the most part,
it is one of the things that still kind of tracks with one another. But
because I tell you, I mean, this is before you're probably born, Brian, but we used to say if the stock market is going down, interest rates are, you know, have the reverse effect.
But lately I've been seeing.
And now we see both going. It's like, now it's just so hard to understand, you know? It's like, is that? But no, you're absolutely correct.
And it's a fair point for someone who might be a little bit older watching this show, or newer, older or newer, older or younger. You know, there's been a decoupling of a couple things. You know, typically, there would be inverse functions of things.
Yes.
So if one goes up, the other one goes down. But now it's like one goes up, they both go up. One goes down, they both go down. So, you know, in this case, I mean, look, I think that the positive news, first of all, is that we've come off of the highs of the 8s. Obviously, 8s were only around for just a little bit of time.
Yeah.
And we've come back down to, below 7s?
Yeah.
I mean, that is really tremendous news for most people. Again, I know it's relatively speaking because, you know, we still are having people watch that they have a 2.5 VA. They got a 3%, 3.5% back in 2020, 2021. So maybe to them, they're like, oh, it's below 7. That still sucks. But someone who's looking to buy a house and they were confronting 8 maybe, 6-8 weeks ago, now they're talking about 6.75 or 7%.
Yeah.
That's a heck of a monthly savings when it comes to the cost comparison.
Yeah, you know, one of the good things that I've been seeing with this is we've been seeing inflation's kind of, it's going down gradually.
Easing.
You know, and it is easing. So therefore, certain things like even the gas, I was just at the gas pump and I mean, it was like in the low $5. I was actually pretty amazed not to be seeing that 6 and change, you know? It's like, okay, I went from filling my car with $150. Now it was 105. Like, oh,
That's
well,
that for the regular consumer could be a huge difference.
no, absolutely,
Well,
absolutely. Even for me now, I
Yeah.
get it. Now I could take Tanya on a date. You know.
Yeah, but
Hey, with this week, baby, we can drive a little bit further than
She's
just
like,
to the opposite
I-
bank.
Let's take that out there.
I heard you saved $45 on gas. You can drive a little faster.
Yeah.
You can coast it a little bit more.
But
No,
no,
but-
you know, giving that, it's just allowing us to, our dollars now is getting stretched. So it's a good news, you know, and seeing that the rates are going down, obviously that's another good thing where it gets people to be a little more enticed to, let me take a look at, you know, what buying a home is going to entail.
And that's so, and off air, I think that is one of the sentiment that we are starting to see when we're talking about what's going on and checking the pulse and having our weekly meetings and all that. It's like, hey, people are warmed up to this idea that this is what a new normal might look like. You know, it's like, okay, 3.5, 2.5, that was abnormal. Now on the opposite end, 8, you're like, relatively speaking, 8, that's abnormal. Okay, where are we going to like settle in? And I think we're looking at where we're going to settle in. Yeah. I mean, there's a chance that there's a chance that the Fed will either pause again and will not raise interest rates again, which is probably an indication that this is what we're going to be looking at for the foreseeable future in 2024.
Yeah,
I think one of the things that I've been hearing a lot is the Fed and the government conditioning, and I go back to that word conditioning because they'll say 6 to 7, 6 to 7, and then on a good day 5%. So they keep saying that, and people are holding the lines to when that happens. And as soon as that happens, and it will, because they already foreshadow it in what they're saying and everything that they mention, if you read between the lines, they'll give you those nuggets. But once that happens, expect the market to get flooded, and we go right back to the same thing. But the thing is that if you join the market right when this happens, then you're already on the tail end of it, and you need to be proactive and get everything in line if you want to have a shot at pulling the trigger before anybody else.
Yeah. Well, I mean, we certainly see a big difference. I mean, just because we're seeing these lower rates doesn't mean that, the future, the outlook for the Fed is everything's fine. They still see that there's a lot of uncertainty out there. There's still a lot of work to do. And remember, Senor Uncle Powell said he wants to get to that 2% inflation rate. So we're still far from it.
Yeah.
The other thing is we don't want to reduce the interest rate so drastic, because then we're going to have that invert that you were talking about where now we have deflation, and that's not good.
So a lot of people have been saying, oh, deflation, and I feel like they think about it like, oh, inflation is bad, so deflation must be good. But little do they know that it's actually, not that good for the consumer
At
because, what happens with that? You start seeing a lot of people being laid off.
Yeah, it's
and banks just these last couple of weeks, I don't know if you guys noticed, they've been laying off thousands of workers silently. Hasn't made the head news, but hey, it's happening, and it's only going to happen a lot more.
Yeah, and
from the beginning of the year.
I think that there's a couple force functions. We're talking about inflation. We're talking about the Fed. We're talking about rates. I think one of the things you're going to see is that people who may have been on the sidelines going, "Yeah, I'm not a buyer at 8. Maybe I'm a buyer at 7. Maybe I'm a buyer at 6.5 on the rate." Some of those people will probably come off the sidelines. But again, to the demand point, when rates go low, then the demand that is on the sidelines might come off the sidelines or sitting on the fence, jump off that fence, and try to get in the game, which then means demand is going to keep prices up. Yeah. So I think that. We recently talked about, NAR's chief economist, Lawrence Yun. I think he's right. I think rates are probably going to be in 6 to 7% range in 2024, number one. Number two, I think he's right that you're going to see a pretty substantial increase of available homes on the market because of the demand, and the sellers who now are this, golden handcuffs at 2.5 or 3, they're going to, I'm older. I am retiring now in the next year or two, and maybe I do have to just sell and have to go buy at 6 or 6.5. And then that could bring some more inventory.
Yeah. I mean, to Brian's point, I want to reiterate of people being prepared. We see the difference. Like, I wanted to print this out, what our current agency is right now for conforming loan limit, which is loan limits, under that 426 mark, with 20% down with the 760 mid credit score, 6.625. Unconventional.
Wow.
Government, really we're talking about FHA and VA, 5.75.
Yeah.
Wow.
Under 6? Under 6.
Oh, shoot.
Obviously, they're 760 mid credit score, which is good. Yeah. I mean, I don't know what the average is out there, but
the averages aside, that's somebody's getting that. So I mean,
absolutely.
Might as well talk about it. I'm sorry, I'm surprised that you said like 5. What did you say? 5.75.
5.75, correct.
That's great. First of all, so everyone who wants a 5.75, then it requires a 7. What did you say? 760.
760 mid credit score.
It takes a 760 to get there.
But that's how fast how things will drop, right?
Dang.
Like in a few days, like 3 days, it'll start. We've been seeing that rate improvement, and just that fast, we're able to see that much of a benefit to whomever is actually current in escrow.
And I believe that it's a lot slower for them to raise rates, but
Yes.
then a lot faster for them to cut. And you're able to see it right now in the pricing because these last couple of weeks, compared to just a month ago, you're seeing a huge difference. That translates to thousands of dollars. in
It's
savings.
almost like when rates are
Absolutely.
getting. It's almost like when rates are being ratcheted up. It's kind of like, oh, we gotta wait and see. In the second there's like a pause. Oh, it's over. Like, we instantly know what's happening. We instantly know what's happening next. Which we don't. But
We don't.
It is funny that the behavioral response is completely different when we're going one way versus the other.
Yeah.
Well, I'm glad. These are,
Going
you know, we keep saying these are the months of giving. You know,
Yeah.
we got Thanksgiving, we got Christmas coming up. So I'm just glad that now the consumer gets to get something. You
Yeah.
know, with inflation going down, now we get to get more gas. Like it was my, you know, my circumstances when I went to the fuel pump.
Yeah.
And now with interest rates, when we locked a couple of clients in, I feel like Santa came a little early.
Yeah,
Right.
I think this is going to be really good for people at the end of the year. And again, like forecasting 2024, you know, we're going to turn the page and go into like what the new conforming loan limits look like. But I think this is going to help people because, you know, there's some indications that there's changes on the financial horizon, and where these lower rates are actually going to couple hand in hand with some changing market things. So.
Yeah.
Let's move to the next article, guys.
Yeah,
which
speaking
is,
of giving, let's go into the next article.
Yeah. Next
transition.
article is the FHFA conforming loan limits are increased to $766,550 in 2024. This, of course, is coming from the Federal Housing Finance Agency. The baseline conforming loan limit for mortgages backed by Fannie Mae and Freddie Mac in 2024 will be $766,550,000, up 5.5% compared to the current limit of $726,200. So this is great news, and to me, right away, my eye goes ding, ding, ding. They are either catching up with home prices, or they are forecasting that they see prices going up even more. in
Yeah, and
2024.
you know, Andy, something like this is really good and interesting for us to see, right? This wasn't started, these conforming loan limits prior to 2008 just were non-existent. Back in the day when I started in the industry back in 2006, you know, when a veteran wanted to come, I want to say the county loan limit was like 417.
It's 417, yeah.
You know, but your medium sales house sale of a home was like 600 and change. So for VA, what that actually meant is they had to put a down payment on that difference.
Yeah, 25% of the difference. Yeah.
But at that point in time, they had what's called an 80-20 or an 80-10-10. What that is in order to avoid mortgage insurance, they do it first at 80% of loan to value of your loan. And then they do either a 10% second and then another second. But the most common one was a 20% piggyback.
80-20, yeah.
You know, 80-20 loan. And, you know, that's the way you would avoid the mortgage insurance. And people had to do that. When you presented like a VA loan, people would be like, nope, we're not going to take that.
Right.
That was kind of looked upon like it's going to be too complicated, so we don't want you to go over there.
Oh, wow.
Where nowadays,
Take the VA.
It was not even close.
absolutely.
Yeah.
But it wasn't able to catch up, you know? And so, I mean, again, you were barely born at that time, Brian.
What was it like,
But
2008?
but it was just pretty crazy. So I'm glad that, you know, in 2008, finally, we had the Housing and Economic Recovery Act that said, hey, we got to start implementing this rule to help people catch up with these loan limits so that they're able to have more people purchasing these homes, you know?
And what it does really too is it kind of loosens the purse strings of money that can come into Fannie Mae and Freddie Mac.
Yeah.
That those mortgage-backed securities can make it into the market. So by having a government securitization, it allows these investment asset managers to dump billions of dollars into this because it's backed by the real estate itself, and so that actually can bring new money in, and new money in the system, or I should say, plentiful money in the system, can help keep rates lower.
Yeah.
Now, the function of rates going lower in 2023 at the same time the loan limits go up creates an affordability opportunity for people who might have been on the sidelines mathematically, not emotionally, not physically. Oh, I can't move here, can't move there. It's actually maybe mathematically they were on the sidelines, and these two things together, I think, are going to open up opportunities for people in 2024.
Yeah. And one simple example would be, you know, the county loan limit was a 726,200, right? So now that that medium sales price here in San Diego went up to like 900, which is pretty crazy. You know, it actually went to 766. So when we talked earlier, if they're given into a conventional loan and they purchased a home at, say, 726, they could expect they're going to get a rate around 6.6%, more or less, right? Government, they're going to get now a 5.75. So now if their loan amount is above that 726, they say 740, now it's going to be at least about 0.5% to 3.25% higher. Because of it. Because now you're not in that conforming where it's advantageous. And that 0.5% and 0.75%, it could be $100-some, and that right there could keep you not being able to afford that.
And for those of you hearing this example that Memo's giving right now, he's talking about high balance loans, and he's talking about jumbo loans, where that's a different bucket of money. That is not money that's Fannie Mae and Freddie Mac. That's money that is a separate purse, if you will. And because there's scarcity in that purse, the rate is typically higher. So the fact that Fannie Mae and Freddie Mac are increasing their conforming loan limit is going to create less expensive money access to people. What's interesting to me, though, and I don't think I knew this actually until I read this article, which was that their conforming loan limit increases based on the formula related to home price data in the third quarter of each year. So that means that they made this decision now in fourth quarter based on third quarter data. So back to my initial point in this segment, which is they're either catching up to where they should be, or they're forecasting where it's going to be quarter 3 versus quarter 3. And so that was interesting to me too, because again, if we are catching up, then that means that there is no deceleration of home price appreciation. It's going to continue appreciating, or it's going to flatten out, right? I mean, what other conclusion could I come to?
Yeah,
and that's exactly what stood out to me, the increase of 5.56%. It just shows that homes are still appreciating despite the market conditions. Even when rates do come down, the prices are still probably going to hold because of the demand. Now that the rates are lower, prices are going to, monthly mortgage payments are going to be lower, and a lot more people are going to be like, now it's time to buy. And houses hopefully, meet the demand.
Yeah, this is totally in line with a lot of the things we've been reading, which is going to create some confusion at the end of the show today because of this Morgan Stanley thing that got sent out, that the home prices are going to plummet. And like, wait, what? That doesn't even mathematically make sense. But
everything's in the data.
But
yet we have a one unit in San Diego because every state has a county, and based on your county, there's going to actually be a loan limit. For instance, the conforming loan limit nationwide is that 726,200 currently.
Yes.
It's going to go up to that 766,500, that 5%. Now for the county of San Diego, we're actually looking at $1,600,000.
You have a breakdown of number of units, right?
Yeah.
1 through 4. So let's go over that.
So that's pretty cool because that actually means with conventional financing, you're looking at that 5% down, no problem. 2 units, now we're looking at $1.2 million, $557,950. 3 unit, $1.409,650. 4 unit, $1.561,350. $350.
Wow.
It's just crazy, guys.
Wow.
This is the first time we've seen it break through the million.
Well, for the single, yeah.
For the single.
And you said the 4 unit is $1.4 million?
1.5
million.
61.
And it's still considered conforming. That means it's going to be backed by Fannie and Freddie.
Well, pretty much.
That's
exactly.
crazy.
For your 4 unit. Yeah.
4 unit.
With
Whoa.
5% down, right? Like, this is crazy.
But I think,
Whoa.
it's that thing that we talked about, that they're going to put in, these strategies, or, help consumers be able to, find more strategies to get creatively inside their properties, right? And I think it works in a perfect way because little do they know that you're able to use that income from those other units and use that as qualifying income if you're smart and you structure the deal correctly.
Yeah,
Absolutely.
so talk about that. Explain that in a little more detail. So you're saying that if you want to buy a fourplex, your income is going to qualify, but you can use the the gross rental income of the other 3 to help with the underwriting.
Correct.
Well, you already explained it.
Basically. No, but for example, like whenever some of our clients were looking for multi-unit properties, some of the properties on the MLS already had a breakdown of what that rental payment was getting. Rental payment was being paid out every month. So you could already utilize that and say, hey, well, the property's already bringing this in. You could use up to 75% of that to qualify for your mortgage payment. As long as you're going to be living in it as a primary residence, then you can get in there, use the income. And if somebody's already living in there, well, great. You're walking into being a tenant. A landlord.
That's awesome.
Yeah.
I don't know how you guys feel about this. I'm not on the front lines of sales anymore, but this is exciting to me because I think this is going to actually create some nice opportunities for people to get into the market.
Well, Andy, you mentioned this back in the beginning of the year that we had to pivot and we had to bring some type of programs to make it more affordable and more appeasing for the consumer. And these are the things, as we're seeing. I know JP Morgan Chase said that home prices are going to plummet and all this. Okay. But obviously, I think Fannie, Freddie, and all them have more analysts that can say the data is going to be different. And therefore, now they've increased the affordability.
But what I like about this is at the end of it all, it gives people that opportunity that, hey, I can get into this real estate investment game as well. And it gives them that opportunity to start being able to see what that belt building process looks like without having to say like, hey, I need to use all my money. Well, now you don't have to use all your money. All you got to do is 5% of the purchase price.
Yeah.
OPM.
This is awesome, guys. I'm really, really excited about this.
Same.
anyone who's watching this part of the segment or this part of the show or just this clip in general, you're looking to buy in 2024 with the new conforming loan limits, whether it's 1, 2, 3, or 4 units, go ahead and talk to Will or to Brian and get that started right now so you're prepared to buy in the new year.
Or wherever you're at in the nation, this is going, we're getting great traction on our YouTube channel, thank you everybody. But talk to your lender, talk to whoever who's around there, and they can guide you through this whole process.
Yeah, good point. All right, so guys, next article, pending home sales dropped to record low, even worse than during the financial crisis. Dun, dun, dun. Historically on the show this year, anything that's connected to 2008, 9, I'm like, oh, God, I hate these comparisons. They're terrible. We all know what happened. But quick key points on this one. Pending home sales in October dropped to the lowest level since the National Association of Realtors began tracking them in 2001. So in the 22 years, they were never lower. Great. Pending home sales. Mortgage rates in October rose sharply, with the average on the 30-year fixed briefly soaring over 8%. We talked about that previously. And rates have since pulled back, but are now still above 7 in some situations, and some are below 7, and supply is tight. So, okay, do you guys think that it's behind us now, or do you think that we're going to see a continuation of low sales?
So is this the bottom?
That's the question. Do you think that October was the bottom for the volume of sales? So this is pending homes. So do you think that we will see fewer pending sales into the new year or more pending sales?
I think it's gonna go up for sure.
I believe definitely has to go up.
Yeah.
Okay.
Here's the thing: when interest rates start dropping, it gives also sellers a little more confidence that the next home that they purchase is gonna have a lesser payment.
Yeah.
So I think there's a lot of moving parts with this. So I think we're gonna see data's gonna perform better.
Yeah,
okay.
and I feel for the people that are okay with not selling because they don't need to sell, because they don't need to pay off debt, because they're not drowning in a financial, distressful situation. They're going to be more lenient to wait to see how the market performs into 2024, to really see how rates perform, how the market performs, and then really make the decision when to enter the market. I feel that they already know they want to sell, but they're just waiting for the opportunity where the rates are a little bit lower. Maybe they have a little bit more options to purchase from. And I think we're going to start seeing that into the beginning first quarter of 2024, we'll start seeing a lot more inventory. This is my opinion.
Yeah.
And you're absolutely right. I mean, with the interest rates being there, as a seller, like I was even looking at myself, what if I sold my house? Yeah, we get that tax advantage of the $500 when you're free, no capital gains. I was like, let me see if I'd explore that. So let's say I have this, I sell my house for $1 million and I have $500,000 there, and I owe $500 to the bank. If I put that $500 and I buy a $1.2 million, my payment that I'm going from $3,000 would actually be like $5,000, even with such a big down payment. Why? Because of the interest rate being that much higher. Mm-hmm. So sometimes for us, like for me, it's kind of like, is it a need or a want? Mm-hmm. And if it's a want, guess what? Right now is not the time to want. Yeah. And right now is the time to do things based on need.
Yeah.
And so the people that we see, that we're noticing we're assisting so much right now is because they're transferring from jobs here and they still don't want to go back to renting. They'd rather say, hey, I'd rather take my chances right now, buy at a high interest rate environment versus interest rates going down and then me having to compete with more buyers who qualify.
Yeah.
Right? Yeah. So that's where the need steps in versus just the want. And
how many times have we talked about this where we talk about like our parents or even our grandparents, like, $187,000 for a house was just astonishing back in the 80s. And you're like, well, I would love one for $187,000 right now in California, in San Diego specifically. So I think there's a retro looking aspect to this too. It's like, it might seem difficult on the front right now on the surface, but over the course of time, of course, you make more money, you pay down debt, you're going to have more to debt service it. And then also, property values that they just historically increase over long durations of time. Whether that's 5, 10, 15, or 20 years, you're going to have a place to live. I think, honestly, part of this whole pending home sales thing is part of the cost of buying a replacement home. It's also an affordability issue because there is demand for homes, but the demand, there's less of it that can actually qualify on paper.
Yeah.
So there's that issue. But if rates have come down and prices have stabilized, people are going, if prices are not going to come down, if I agree that the new normal is prices are going to stay where they're at, then the only way for me to get in, if I can't afford it now, is for the rates to go down, which now I can't afford, I'm going to have to get in, which means demand back. So if that demand comes back, then home prices, again, inverse, the home prices are going to stay or go up. And I think that's part of what they're saying is going to make October the gutter. I think that's why they go, people are going to end up, their demand hasn't gone away. Demand is going to come back.
Yeah. October was definitely a rough month.
I think the demand's going to come back in the new year. I
absolutely.
just, it's not going to go away because the shelter problem hasn't gone away. I mean, look at what the California is trying to do, giving more grant money out for people to build ADUs, and now even being able to sell ADUs as separate units. Like they're creatively trying to solve a number of different housing issues all at the same time, and that is because the demand is not being absorbed yet, and we don't have enough supply coming on board from new construction.
Yeah. I mean, hey, I took a class in economics, 101, 102, and one of the things that just strikes me the most, right, is what my instructor said. It's simple economics.
Yeah.
Supply and demand.
Supply and demand.
And guess what's happening to our population every 50 years?
Doubling.
We're doubling.
Yeah.
So therefore, we're not caught up, to building as many homes as we need to right now. So definitely, to your point, yes, we're going to see cycles going up and down, but moving forward, this is very, very extremely different than 2008. 2008, in 2009, 10, 11, we had a huge amount of inventory.
Yeah.
And that's why prices just went down and they took a beating.
Well, one of the things my final thought on this for me, guys, is whenever you're at the bottom, everything's looking up.
Yeah. Or when you're on the butt. Yeah, vice versa, right? Yeah, it's true. So
All
true.
right. Well, let's close out today, guys. We're going to talk about this. I'm going to say relatively confusing Morgan Stanley note that was sent out around their advisors. It says home prices will fall in 2024. Okay, so that's just the title. This is a Morgan Stanley internal memo that went out talking about basically their rationale for home prices going down. So mortgage rates will fall, incomes will continue to rise, and an uptick in listings will spur more housing activity, and it will even lower home prices.
Wow.
So here's what I'm confused by. If mortgage rates will fall, that increases affordability, increases interest in some cases. That makes affordability easier. If incomes continue to rise, that also makes affordability easier. And if more people can buy and there's more people demanding homes, how does that mean that prices are going to go down? Am I missing something?
Well, because if they're going to raise wages, that means people are going to have more money to spend, which is going to be dispersed into the economy, which then causes inflation, which causes prices to go up, which then goes back to the same thing.
But it says that analysts believe that the housing market is unlikely to see significant decreases in inventory. Okay, well, if a shortage of supply is already helping keep prices high, how, if we don't have any more decreases? I don't understand. There's something functionally that I don't understand.
Neither
here.
does Uncle Powell.
They're saying they expect home prices to fall modestly as housing activity picks up. But that's typically not the case. The only time I can think that maybe that was happening is when there was too many that flooded the market at the same time, but they were bank owned. I am going back to 2008, 2009 in this one, where we saw hundreds of thousands of homes come on board quickly, fire sale almost, if you will, and prices were dropping fast because we had so many properties that the banking system took back and had to sell.
Yeah. I mean, it's very difficult to pinpoint exactly where. Here in San Diego, it's just not happening. Other places in the nation, it could be happening very well. This could be very, very true. But we're talking about it here, right? I'm going to say more of my opinion here in San Diego. I don't see that happening as Morgan Stanley would state here. The other thing is we also follow our research. So, Altos is something we always follow the data, and data is not going to lie. Data is there. As a matter of fact, when Altos back in 2005, 6, he went to Bear Stearns and Lehman Brothers and said, hey, I have all this data, and here it is, you guys. Hire me so I can help you because we're going to see this huge meltdown. That's, he was already foreseeing it based on the data. Guess what? They turned him down. Well, what do you mean? We already have 25, 35 analysts here. What is it that that they don't? Well, guess what? He had all the evidence because he was able to monitor all the data and knew exactly where we're heading. He feels very confident based on moving forward into 2024 that we should see a little more inventory, right? Yeah. But we're not going to expect house prices to drop significantly.
Yeah, and that's the part I think that is concerning, is that the memo is saying things that actually conflict in the variables of the said formula. And so if we see an increase in demand, that typically comes with prices stabilizing or going higher. If money gets cheaper, then prices go up. But that's already why you saw such a rampant rise in home prices in 2020, 21, and 22, is because the money was dirt cheap. Yeah. And people were trying to get out of the city or out of wherever or get to the place they want to be next or whatever the reason was. they did that at 3.5% rates, at 2.5% mortgage rates. So, okay, and instead of affording $500,000 at 7%, I can afford $750 at 2.5% or whatever it is.
So I'm laughing. The thing that came across to me is I saw an interesting text that come from my mother-in-law. It says, if you're complaining of your life, be considerate of the people that live in California.
Oh my God. Oh man. No, that's funny. People watching out of state, they're like suckers. So just a couple of quick things here, guys. They're saying that they expect stronger housing activity in the second half of 2024 and new home sales to increase 7.5%. And existing home sales to go up 2.5%. So we're talking about not in price, we're talking about volume. So the number of units that change hands, they're expecting to go up by 7.5%, and existing home sales go up by 2.5%. But again, that home prices will be down. So I'm trying to think about what would be the reason for that. How can you see more volume come onto the market and the prices go down by 3% when the demand is already there? The demand is not even being absorbed with the current amount. So even if the inventory increases, it will maybe meet the demand 1-to-1. That still doesn't maybe make sense for there to be a 3% or 8%.
I don't know.
correction.
Maybe they're considering the whole Airbnb thing. How
That's
everybody's
possible.
going, oh, Airbnb collapse. You're going to see more homes available, et cetera, et cetera. But again, you got to do the data. You got to know how many Airbnbs are going to be in each state, and then kind of see like, well, when is it going to happen where Airbnb is no longer accepted in that state?
Yeah.
We don't know. I know that New York right now is kind of removed that, but
Yeah, the rules are changing on that. But I think also, again, referencing another state, I think in some places it might actually be that. It could be going down
Correct.
in some areas that were overbought. Maybe there are places in Idaho that are overbought, and some in Tennessee that were overbought, and those prices have to correct. And then on average might maybe create a negative home price average. But I guess one of my kind of last assessments of this when I was reading through this in preparation for the show is that, this whole idea that the correction could be as much as 8%, 8% less. I'm sorry, that home prices could correct downward 8%. There's not even charting that looks like that. And we had a correction already in the summer of 2022 when rates started going up again. Prices did take a little bit of a dip, but they flattened out, and then they're starting to trickle back again.
Yeah.
So I think that the correction is already behind us, and I don't see any trend on charts that looks like there would be a forecast of further correction or a second correction.
yeah.
You think anything would have to do with unemployment going up?
Well, possibly, but if that happens again, or if that does happen, then again, that's inventory to already meet demand that's already in the market. There's already demand for that.
Yeah.
So I don't think that we have, again, we'd have to go and have so many more homes hit the market than there's demand for in order for there to be price wars on the way down versus price wars on the way up. If we're seeing houses go for sale and we get our buyer in and there's 10 offers, that means 9 people are still looking.
Yeah.
So that means for every house that gets 10 offers, we need 9 more houses just to meet the current demand.
Yeah.
So that's a 9-to-1 ratio. That would have to have so many. Think about having 9x the amount of homes come on the market next year in order to meet that demand. That's kind of what we're talking about in this little silly example. But anyways, I'm very curious to see what happens in 2024 and see if this actually prevails or if what we're talking about is what ends up happening.
So let's save this one.
Let's save this
We'll come
one.
back
Yeah.
and-
This one.
yeah.
Timestamp this one, December 2023. Let's see if the guys were right or deadly wrong. I guarantee you it'll be scary if we were wrong
Right.
and they were right. Oh my God.
This
that
is
would
just
be
crazy.
nuts. So, all right, guys. So let's go on to the end of the show. Let's talk about what we like best about the show today. Memo, what was your favorite part of the show today?
Yeah, my favorite part of the show is right now that we are in the season of being grateful and thankful and spending time with family. I think Uncle Pal came good and reduced our interest rate. So I like that part of it, that we are finally giving some type of encouragement and allowing the people to just, enjoy this part of giving, as well as the conforming loan limits, going up. It's just, again, giving that encouragement, giving that I sucked. Sorry.
That's okay. Let's do it again. You ready?
I sucked on
All right.
this.
That's
Totally
okay.
not the way that I wanted to go.
You're okay. And
But, okay, let's go.
Ready?
Go ahead.
3, 2. All right, guys, let's go to the end of the show. So, Memo, what was the favorite part of the show for you today?
My favorite part of the show was, this is the time to be grateful and thankful for many things. So I'm just glad that we see interest rates, going down. And then the great part of it is we'll also see conforming loans limit increasing. So I'm very grateful to give not only myself, but our consumer the encouragement of wanting to go out there and let's just get something done. So I'm grateful for that.
Awesome. How about you, Brian?
Well, just like Will said, mortgage rates are down. Hopefully no frowns going into the holiday season. And, positivity outlook into 2023. Call your mom, call your dad, call your family, tell them you love them, send hugs, send a card. I'll see you guys in 2023.
Really good.
This is the time.
Favorite part of the show for me, guys, was affordability coming back. I mean, it's kind of the confluence of both those things. Rates going down, the conforming loan limit coming up in 2024. I think it's really going to help people who are like mathematically out of the game, not out of their hearts in trying to buy a home. They want to be in the homeownership game, but they just are mathematically out of it right now. But I think this is actually going to be helpful. Rates going down, conforming limit going up. I'm really encouraged by that. I think it will bring new inventory, bring new buyers. It'll resurge some demand, and I think home prices are going to stay and even go up a little bit in 2024. So, and also the sentiments you guys shared. Yeah, tell your loved ones you love them. Give them a hug. Give them a kiss. Tell them how much they mean to you during the holiday season. And all of you watching, we love you too. Thank you so much for watching. If you're on YouTube, remember to like the channel or like the video, subscribe to the channel, and make sure you turn on the notifications so you catch every episode. And if you're listening on Google and Apple, make sure you have direct download on so every time we put a new episode out, you hear about it first. Thank you guys for a great show. Thank you all for watching and listening, and we'll see you again next week.